Welcome back. This is Retirement News Online. So the news about trade wars and China's economic challenges have many wondering about a recession or a bear market shift. And for retirees, sequence of returns risk or the possibility of a market correction early in retirement can be a serious concern. And my guest is Zach Abraham, who practices in Seattle, Washington. Zach, thanks for taking the time to join us today. And I just wanted to start out by getting your take on global economic conditions right now.
First of all, I think that's a great question, and unfortunately, I think it's something that is not addressed nearly often enough. I think it's really important for people to understand that when we're looking at investments, when we're looking at stock markets, it's a picture's worth 1,000 words. We look at I think of the stock market as a picture. It is giving us a lot of information, but we have to understand that what it's telling us is very different than what it was telling us 20, 30, 40 years ago. The single biggest driver over the last 10 years of economies and markets and stocks and bonds are central banks. And this is not a conspiracy theory. This isn't, some wingnut out there trying to freak people out. But if we look at all this quote-unquote stimulus that's been pumped into the system over the last 10 years, the European Central Bank, the Federal Reserve, the People's Bank of China, the major economies of the world have printed the equivalent of $22 trillion out of thin air. And that has been the biggest driver of economies. That is new, Scott. That is not a consistent state of being. And so now what does that have to do with geopolitical risk? Well, a lot of these central banks around the world have been coordinating their efforts, getting the most bang for the buck, you might say, and for the printed buck. That's a little joke will slide in there. But in all seriousness, geopolitical risk, just due to that, is much more of something that we need to pay attention to than ever before, because we know that we have stock markets at near record high valuations. We know that we've got $12 trillion worth of sovereign debt currently paying negative interest rates. We know we have all of these anomalies around the market that are only able to be seen or be realized because of the extraordinary measures central banks have taken. Geopolitical tensions, our issues with China, they threaten all of that central bank coordination. And so you could see the market you could see the rug get pulled out from underneath the market in a way that we really haven't seen in the last 20 or 30 years, just due to central banks not cooperating anymore. And that's sort of an inevitability. So I think the geopolitical risk is big. The other side of it, Scott, is that it's not easy really to predict. These things can happen over weekends. They can happen if Iran decides to shoot down a spy drone, right? So you need some absolute protection, and you need a portion of your portfolio that can stand up to any of those types of risks.
So going back to the topic here, sequence of returns risk, how do you determine if you are at risk in this situation, in the event, for example, of another market correction?
Yeah, so this is another great question, and this is something that we focus on a lot. Everybody thinks of returns, and I cringe every time I hear it. Every advisor will get out there and tell you, the stock market makes 11% a year. Now, we could go into that alone because, first of all, that's a nominal growth rate, so it doesn't factor into it inflation. So if we want to look at real growth rates, the stock market's more like between 8 to 9% a year, but that's another discussion for another day. That's really, regardless of the inflation side of it, that's really a misleading idea. And people think, I'm just going to stick my money in the stock market and I'm going to average my 11%. I think the last 20 years are a perfect example. The average 60-40 portfolio, so 60% stocks, 20% bonds, has underperformed its own projections. So if you'd have gotten a financial advisor from Morgan Stanley 20 years ago, 1999, and he'd have put together this retirement portfolio, on average, that portfolio would have underperformed their own projections, so their own averages, by 40 to 50%. And we all know why, right? One of the biggest reasons are, the tech bubble in 99 and then the real estate collapse. Then on top of that, something that most people don't think about is we have bonds giving, a quarter or a third of the yield that they typically do because they're at record prices as well. So getting back to sequencing risk, how does this play in? When first of all, like I said, in those two examples over the last 20 years, you've gotten way less of your returns. So, and we kind of tie sequencing risk to that, because the less we're making on our investments, the bigger impact our withdrawals are having, right? And when we have to, if let's say we have a 40% drop in the stock market, which people go, oh, that's obscene, and you go, no, not at all. I mean, again, we're overdue for something like that, way overdue. But if you have a 40% drop in the stock market your first year out of retirement, if we've set up a financial plan for you, and sort of the universal financial planning number that every firm uses, they can dress it up in a program or whatever, but if you want to know how income planning works, 98% of the time it's whatever your asset base is and 4% of that number. So if you got $1 million, you shouldn't spend your assets down by more than $40,000. If we build you a financial plan based on that information, and 6 months to a year into retirement, your assets take a 40% hit, your cost of living does not drop a commensurate 40%. So now all of a sudden that 4% withdrawal, which is totally normal and totally healthy, and that's inside the safe zone, now all of a sudden that 40% withdrawal is more like 7.5%. And so and that money, you can't not take it, right? You have to live on it. And so people go, oh, I'm taking too much. And if we go through one of these periods in our retirement, the chances are very, very, very slight that we'll ever recover from it, because it's got long-reaching implications. And one of them is yes, you are just burning your money down too fast. We want you at 4%. You're nearly double that. The other side, though, that nobody thinks about, Scott, is that you're selling those assets. You got to make room in the portfolio. You got to liquidate assets. So you're doing it at the lows. You're doing it when these things are down 40%. So while the market may bounce back over the next 5 or 6 years, you won't. You're not going to be back to even in the next 5 or 6 years, because you had to sell off all of those assets to finance your lifestyle along the way. And this is really why we believe that there has to be a portion of your portfolio that can stand up to anything, and that it's sufficient enough to fund our retirement through 3 to 5 year periods of turmoil, so we can allow the other assets time to regain, right, or time to recover without having to sell them in the down. And I think that's the thing that most people miss. It's not about the loss in the downturn. It's about what the loss makes you do. And it makes you sell off assets at low prices, so when things recover, you don't. And I think that's the biggest part of it that people miss. The game changes. Yes, I think the stock market will probably be, the best investment in general over the next 30 years. But that's assuming you just leave your money sit there and just let it ride. But when you go into retirement, you start taking distributions. And that's a game changer, and I don't think enough advisors really delineate and discuss with their clients that risk, and how we need to have a portion of our portfolio that we refer to as, break glass when fire, right? That protects the rest of our assets so we can let them recover.
That was Zach Abraham in Seattle, Washington. Thanks for watching Retirement News Online.